So you've finally done it. After months or maybe even years of working, budgeting, and saying no to things you wanted, you finally saved your first $20,000. First of all, congratulations, because reaching this point is already something most people never do. But now comes the harder question. What should you actually do with that money? Should you leave it sitting in your bank account? Buy individual stocks? Invest in real estate? Wait for the market to crash? Or maybe keep researching because you're afraid of making the wrong decision. If that's where you are right now, you're not alone. In fact, thousands of people spend years building their first investment fund, only to leave it sitting in cash because they're scared to invest it. Ironically, doing nothing is often the most expensive decision you can make. Hi, I'm Noah, and if I had to start over today with my first $20,000 in August 2026, knowing everything I know now, this is exactly what I'd buy. Not because it's flashy, not because it promises overnight riches, but because it's the strategy I trust to build real wealth over the next 20 or 30 years. By the end of this video, you'll know exactly how I'd approach my first investment, what I'd avoid completely, and the 3 mistakes that quietly destroy more beginner portfolios than market crashes ever could. So let's start with the one question almost nobody asks. Why invest at all? Most people think saving money is enough. It isn't. Saving protects your money. Investing grows it. There's a huge difference. Imagine you've got that $20,000 sitting safely in a bank account. It feels secure. Nothing seems to be happening, but something is happening. Inflation. Every single year, inflation quietly reduces what your money can buy. Think about a cup of coffee. A few years ago, it might have cost $3. Today, that same coffee could easily cost 5. The coffee didn't suddenly become twice as good. Your money simply became a little less powerful. Now imagine that happening to groceries, rent, insurance, healthcare, travel. Almost everything gets more expensive over time. So if your money never grows, your purchasing power slowly shrinks. That's why investing matters. Because instead of watching inflation slowly work against you, you allow your money to start working for you. And that's one of the biggest mindset shifts you'll ever make. You stop depending on one income source, your paycheck, and you begin building another one, your investments. Now here's something many beginners misunderstand. People think investing is complicated because they hear words like ETFs, index funds, stocks, compound interest. But the truth is, your investments only grow in 2 basic ways. The first is ownership. When you buy shares of a company, you own a tiny piece of that business. If the business grows, your investment grows too. Imagine a company creates better products, expands into new countries, earns higher profits year after year. As the business becomes more valuable, the shares become more valuable. Since you own part of the company, you benefit from that growth. That's the first engine. The second engine is even more powerful. Compound growth. This is where investing starts becoming truly life-changing. Imagine investing money that earns an average return every year. Next year, you don't just earn returns on the money you invested, you also earn returns on last year's returns. Then those returns start earning returns too. Your money begins growing on itself. Think of it like a snowball rolling downhill. At first, it's tiny. It barely moves. But the longer it rolls, the larger it becomes. Eventually, and the snowball gains size much faster than it did in the beginning, your investments behave exactly the same way. The early years feel slow, sometimes frustratingly slow, but over time, growth starts creating more growth. And that's exactly why people who start earlier usually finish much further ahead than people trying to perfectly time the market. Because when it comes to investing, time is almost always more important than timing. Before I invested a single dollar of that $20,000, there are 2 things I'd take care of first. Because investing with confidence feels completely different from investing while constantly worrying about money. And the first one is expensive debt. The first thing I do is eliminate any high-interest debt. Because here's a simple way to think about it. Imagine you're trying to fill a bathtub with water, but before you turned on the faucet, someone pulled the drain plug. No matter how much water you pour in, the tub never fills. That's exactly what high-interest debt does to your finances. Let's say you're carrying a credit card balance charging 20% interest every year. If you invest your money and earn an average market return of 8%, but you're paying 20% to the bank, you're still moving backwards. In other words, paying off that debt is like earning a guaranteed 20% return. No investment on earth can promise you that consistently. So before worrying about building wealth, I'd stop losing it. Because once that financial leak is fixed, Every future dollar you invest gets to work for you instead of your lender. The second thing I'd build after expensive debt, I'd focus on something that doesn't sound exciting at all. An emergency fund. Most people think emergency savings slow down investing. I think they make investing possible because life doesn't care whether the stock market is having a good year. Cars break down. People lose jobs, medical bills arrive, unexpected expenses happen. And if every dollar you own is invested, you'll eventually be forced to sell investments at exactly the wrong time. Usually, when prices are already down. That's how temporary market declines become permanent losses. An emergency fund prevents that. Personally, I'd want at least 3 months of essential expenses saved. If I had children, a mortgage, or people depending on me, I'd probably increase that to 6 months or even longer. The purpose isn't to grow this money aggressively. Its job is simply to protect the rest of your investments. Think of it as your financial shock absorber. You hope you never need it, but when life throws you a surprise, you'll be incredibly grateful it's there. Never ignore free money. There's one opportunity I'd never skip. Employer retirement matching. If your company offers to match part of your retirement contributions, take every dollar they're willing to give. Seriously, it's one of the easiest financial wins you'll ever find. Imagine investing $100 and your employer immediately adds another $100 before the market even opens. You've doubled your money. There are very few opportunities in investing that come with a guaranteed return. This is one of them. Yet thousands of people walk away from this benefit every year, simply because they don't understand how valuable it really is. If free money's available, take it every single time. And if your country offers tax-advantaged investment accounts, I'd use those next, because the less money you lose to taxes, the faster your investments can grow over time. So, what would I actually invest in? Now we arrive at the question everyone asks. If I had my first $20,000 sitting in my account today, where would I actually invest it? Most beginners immediately think about individual stocks. Apple, Nvidia, Tesla, Amazon. Whatever company has been dominating headlines recently. And honestly, I understand why. Watching one stock double in value sounds exciting. But excitement isn't what builds long-term wealth. Consistency does. History has shown us this again and again. Every decade had companies people believed were unstoppable. Some of those companies barely exist today. Others lost most of their value. That's why I wouldn't build my financial future around guessing which company will dominate the next 20 years. Instead, I'd buy the market. Not one company, thousands of companies. That's exactly what index funds allow you to do. Instead of betting everything on one business, you own small pieces of hundreds or even thousands of businesses around the world. If one company struggles, others continue growing. You're no longer relying on one CEO, one product launch, or one earnings report. You're relying on the long-term growth of the global economy itself. It's not the most exciting strategy. In fact, some people think it's almost boring. But boring investing has made far more millionaires than exciting investing ever has. Because investing isn't about finding the next winner. It's about owning enough winners that time quietly does the heavy lifting for you. Now, before we go any further, I want to answer one question that almost every beginner eventually asks. Should I invest in stocks or should I buy property instead? The truth is, both can build wealth, but they're very different investments. Real estate has helped countless people create long-term wealth, but it also comes with a much higher barrier to entry. Buying an investment property usually means saving for a large down payment, qualifying for a mortgage, paying closing costs, handling maintenance, insurance, property taxes, and if you're renting it out, managing tenants and unexpected repairs. For some people, that's absolutely worth it. For others, it becomes another full-time job. Investing in the stock market is very different. You don't need tens of thousands of dollars to begin. You don't need to fix broken plumbing. You don't need to answer midnight phone calls because a water heater stopped working. You simply invest, stay consistent, and allow time to do most of the work. That's one of the biggest reasons I'd choose the stock market with my first $20,000. It's simpler, more liquid, more diversified, and far easier to automate. So, what would I actually buy? If I were starting from scratch in August 2026, most of my money would go into low-cost index funds, not because they're exciting, but because they've consistently rewarded patient investors for decades. An index fund doesn't try to predict tomorrow's winners. Instead, it owns hundreds or even thousands of companies all at once. Some businesses will struggle, others will become massive success stories. The beauty is, You don't need to know which ones they'll be. The winners naturally become a bigger part of your portfolio over time. That's why so many experienced investors eventually stop chasing individual stocks. They simply own the market. Then they let compounding handle the rest. I'd also automate every investment. The moment each paycheck arrived, a fixed amount would automatically move into my investment account. No emotions, no guessing, no waiting for the perfect moment. Because the perfect moment almost never feels perfect while you're living through it. Consistency beats prediction, almost every single time. The three biggest mistakes I'd avoid. Now let's talk about the mistakes that quietly destroy more portfolios than market crashes ever do. Mistake number one, waiting until you feel ready. This is one of the most expensive delays in personal finance. People spend months, sometimes years, watching investing videos, reading books, listening to podcasts, always telling themselves, I'll start once I know a little more. The problem is, while you're waiting, time keeps moving, and time is the most valuable asset any investor has. You don't need to know everything before you begin. You simply need a solid foundation, a sensible plan, and the discipline to stay consistent. Start small, learn while you invest. Your future self will thank you. Mistake number two, chasing whatever everyone else is talking about. Every market cycle has its hottest stock, its hottest cryptocurrency, its can't-miss opportunity, and almost every cycle ends the same way. People buy after prices have already exploded, then panic when prices fall. Investing isn't supposed to feel exciting every day. If it does, you're probably taking too much risk. The goal isn't to impress people with incredible gains for 1 year. The goal is to quietly build wealth for decades. If you enjoy picking individual companies, that's perfectly fine. Just make sure it's only a small part of your portfolio. Treat it as money you're comfortable learning with, not money your future depends on. Mistake number three, selling during market crashes. This is where emotions become expensive. Markets fall. They always have, and they always will. When that happens, many investors panic. They sell because they believe they're protecting themselves. But in reality, they're locking in losses. The market has recovered from recessions, financial crises, technology crashes, global pandemics, and countless periods of uncertainty. Every single recovery rewarded the investors who stayed patient. That's why I never invest money I'll need next month, or even next year. I invest money meant for the next decade, because short-term volatility becomes much less frightening when your time horizon is long enough. Here's exactly what I do. And if someone handed me my first $20,000 today, this would be my plan. First, I'd eliminate any high-interest debt. Second, I'd build a healthy emergency fund. Third, I'd claim every dollar of employer retirement matching available. Fourth, I'd invest the majority of the remaining money into diversified, low-cost index funds. Then, I'd automate monthly contributions, ignore daily market headlines, stop checking my portfolio every few hours, and simply continue investing month after month. Because building wealth isn't usually about finding one perfect investment. It's about making hundreds of good decisions, repeated consistently for many years. If there's one lesson I hope you take away from this video, it's this. Your first $20,000 isn't important because of the number itself. It's important because of what it becomes. That first investment is the seed. Every future milestone grows from it. The first $100,000, the second, the third. Eventually, your investments begin generating more growth than your own monthly contributions ever could. That's the real power of investing. Not getting rich overnight, but giving your money enough time to quietly multiply while you focus on living your life. The hardest step isn't choosing the perfect investment. It's deciding to begin. Because once you start, consistency becomes far more valuable than perfection. If you found this helpful, make sure you subscribe, because in the next video, we'll break down the biggest investing mistakes that quietly cost beginners thousands of dollars, and more importantly, how to avoid every one of them. Thanks for watching, and I'll see you in the next one.